Let's talk about buy and hold investing, which is actually not a bad strategy. The only problem with it is how hard it is to actually execute, especially when you're getting market drops like this, like what we've just experienced. So in this video, we're going to talk about what buy and hold is, how do you use it, what's good about it, and what's bad about it. But first, if you haven't already, make sure you check out Strategy Builder Pro. It closes Sunday, so check it out now. There's a link down below in the description and comments. And it teaches you how to build your own professional investment strategy, which will not be buy and hold, and will likely be more effective for you. But first, we got to know what buy and hold is, right? So buying and holding when it comes to the stock market is just buying stocks and holding them until retirement and not touching it. So there's no trading or anything like that. Nowadays, the best way to do that is through an ETF, like SPY, so you get exposure to the entire market by just buying one instrument. So like I said, this is not a bad strategy. It's what every financial advisor will tell you to do. And the reason it's not bad is because of how the US stock market works. Here's an article from Charlie Bilello explaining how good the returns can be. So since the end of 2008, the S&P 500 has gained 351% with only one down year, which was a small loss of 4.4% in 2018. That's a gain of 14.7% per year compounded over 11 years. And if you look at a chart of those returns, yeah, it looks pretty good. It looks so good, in fact, that it's a little bit misleading, but we'll talk about that in a second. Now, if you think about it from a macro perspective, what you're doing when you buy and hold is you're betting on America. You're betting that our economy keeps growing and stays strong, and the companies that make up that economy, well, they'll become strong too. You're betting that our American economy will stay strong for decades into the future. And the way you're betting on that is through the individual companies that make up that economy. And I would agree with that bet because America still looks like the best bet for the next 40 years or so. Now, of course, there are many people who would argue otherwise. But if you're buying and holding, that's the bet you're making. So it's a good strategy and it can work. But the reason why it might not work is because of what actually happens in the market. There are times when the volatility gets really rough. And the trick for buy and hold is to buy and hold. You're not supposed to sell until retirement time. But when the market gets rough and volatile and you see things dropping 10-20%, what happens? Most people sell. So like Charlie says, it seems like an easy ride, but any investor who lived through the last 11 years will tell you otherwise. And again, this is just from 2009 to 2019, which is historically one of the greatest bull markets ever. So since the 2009 March low, there have been 25 corrections of more than 5%. And of these, 8 were larger than 10%, and 2 exceeded 20%. And that doesn't sound like a lot in percentage terms. And that's why many will tell you that they can easily stomach a 20% decline, no problem. They can tolerate that risk. But when it actually happens and the real dollars are at stake, the test actually begins. And that's when all the emotions come flooding in and you start feeling all those negative feelings. You get scared because this is what a 20% decline looks like in real time. And if you're buying and holding, which a lot of times is done through your retirement accounts, this is your life savings, the value of it. Imagine seeing it fluctuate like this and within a few days drop like this. This is the 2011 correction that happened in the S&P 500. And in just a few months from May to October, you lose over 20% of your life savings. And then on top of seeing, the objective reality of how much you're losing, you got the media fueling it, making you even more scared. These were some of the headlines on the very last day of this correction, the bottom. Stocks tumble into the fourth quarter, junk bonds get crushed in market chaos. The worst quarter since the 2008 financial crisis, and the swoon is hardly over. Eerily reminiscent of the months leading up to Lehman Brothers bankruptcy in 2008. And this was at the bottom. And remember, the key to this buy and hold strategy is not to sell out. Imagine how you'd be feeling at this time. And if you made it through 2011, you would be tested again 7 years later. In 2018, we saw another huge correction, 20% in a few months. And then once again, you get the same headlines. Worst week since the Great Recession. The last time the market fell this much was in 1931 during the Great Depression. Even right now with this current market, the market dropped over 9%. And this is just in a few days. Realistically, how many people are holding through drops like this? Clearly not everyone is holding, because if they were, then it wouldn't be falling like this. They're selling out. The more people sell, the lower the prices go. And that's the big trap about buy and hold. It's because you think you can do it, but then when you actually get caught in that situation, a lot of times you end up selling at the worst moment. Like we were just showing those headlines at the bottom. The headlines were calling for even further downside. So eventually, you get fed up and you say, I'm done with this. Let me sell out and protect what I have. And as soon as you do that, that's when the market starts turning around. So in that way, the buy and hold strategy is strange because it is the best strategy for most people, but it's also not easy to execute. I think the problem with trading and investing is that it's very accessible. And it's not a problem that it shouldn't be accessible, but because it's so easy for anyone to get started right away, everyone thinks that it's an easy thing to do. They get the wrong impression. It's not like you go see a surgeon operate and then you think, hey, I can do that, and you just jump in. No, that guy went to to med school and then a fellowship in college, all this stuff. And now he's super old and in a bunch of debt, and that's what it takes to become a surgeon. And there's also strict rules that not anyone can get a scalpel and operate on anybody, right? But there's no rules like that for the market. You can just jump in. So everyone thinks they're real smart with the markets, but they don't have training most of the time. Now, another reason why I think buy and hold is good though is because if you don't have training, then yeah, that's probably the best strategy you should go with. Unless you're treating the market professionally or as a serious hobby, it's not worth for you to try and trade, because the most likely outcome is that you're going to lose. So yes, buy and hold would be the better strategy, but you still need some training. Just like everyone should go to the gym, but even to go to the gym, you do need some instruction to start out, right? That way you don't drop a weight on your head. And our society and schools don't do a good job of this, of teaching market basics and like economics. Because even if it's just your retirement there and you're supposedly not looking at it and you're just buy and hold, you're still in danger during rough times like this. So in my opinion, anyone who has money in the market, which is a lot of people, they need to at least understand the basics of how the market works. So they need to understand risk and volatility and how that interacts with their own psychology about money. So like Charlie explains in this article, risk is the price you pay for the possibility of higher long-term reward. So if you look at the market since 1928, the S&P 500 has generated an annualized total return of roughly 10% versus 5% for bonds and 3% for cash. So it does much better than other asset classes, but those better returns that you're getting from owning stocks over bonds and cash is because there's more volatility and drawdowns that you have to go through. Look at this chart right here comparing stocks to bonds. Bonds are the orange and stocks are the blue. You're getting much bigger drops with the blue, the stocks, but that's the price you're going to pay for the higher returns. If you look at the stats again, in the median year since 1928, an investor in the S&P 500 has experienced a 13% drawdown at some point during the year. That means you can't be surprised when your whole retirement gets cut by 10%, when you all of a sudden go from $1 million to 900,000. And again, 10% does not seem like a lot, which is why you probably shouldn't even use percentages. You should convert to dollars. So a 50% decline when you have $10,000 invested early in your career is not going to be viewed the same as when you're closer to retirement and have $1 million invested. And these 50% drawdowns do happen in crashes, which are always going to come. So a $5,000 drawdown is a lot more manageable than a $500,000 drawdown. Even though the percentages are the same, the dollar amount really affects all of us. And that's part of what you really need to analyze when you're doing buy and hold. You got to be really objective with what your risk tolerance actually is. There's only one Warren Buffett for a reason. Barely anyone can handle the drawdowns that he's able to handle. Here's a good quote from Peter Lynch. You get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets. So to sum it all up, buy and hold is a good strategy and it does work, but it's not that simple. It's a roller coaster. I myself can't do it. That's why I don't buy and hold. I need a strategy where my risk is more manageable, where I don't have to see a 50% drawdown. So my strategy is really tight on risk control because I prefer cutting off some of that volatility to the downside. And the way I do that with my strategy is through position sizing, entries, exits, general risk management, and more. And the stuff I'm talking about, that trade management, is exactly what we go over in Strategy Builder Pro. Because if you move from buy and hold to actual more active investing, then you realize your whole job becomes managing risk. Because you see these returns from buy and hold, right? They're awesome if you can do it. Not many active managers can even beat it. But when they do beat it, a lot of the times they're beating it by just better risk control. Like instead of an account dropping 50%, it drops 10%. And that really adds up over the long term. So if you want to learn more about that, definitely check out the link down below in the description and comments, and do that now because this closes Sunday. So check that out and make sure you're protected against drops like this. Really comes in handy. And if you haven't already, make sure you subscribe to this channel and hit that notification bell so you get email notifications of new videos that come out. We publish a bunch all week. So subscribe and I'll see you in the next one. Stay fallible out there. Bye.